So now we will begin with standard 1B, independence and objectivity. So members and candidates must use reasonable care and judgment to achieve and maintain independence and objectivity in their professional activities. Members and candidates must not offer, solicit, or accept any gift, benefit, compensation, or consideration that could be expected to that reasonably could be expected to compromise their own or another's independence and objectivity. Reasonably could be expected to compromise, meaning that if you are accepting or giving gift or benefit or any kind of consideration which can impede your independence or objectivity, then you are in violation of this standard 1B. So you have to do you must take reasonable care and judgment to achieve and maintain independence and objectivity, and you must not offer, solicit, or accept any kind of gift or consideration. So token gift are still allowed, like pen or pencil, or someone gifts you normal gifts. Those normal gifts are allowed, but lavish gifts, expensive tickets and expensive resort, or if someone books a private jet for you or something like that, which can potentially impede your independence and objectivity, meaning that with all those gifts, you will give recommendation in that person's favor. So if you do that, then you are in violation of standard 1B, independence and objectivity. So members and candidate must use reasonable care and judgment to achieve and maintain independence and objectivity in their professional activities. Members and candidates must not offer, solicit, or accept gifts, benefit, compensation, or consideration that could be expected to compromise their own or another person's independence and objectivity. So if you are giving gifts to someone else in order to benefit from the service that other person gives, then also you are violating this particular standard. So you should not take the gift. At the same time, if you have that position, that if you are a portfolio manager, and let's say if you are um, if you are taking some sort of service from someone regarding a particular company, and that particular um, person or a client, if he or she gives you a negative recommendation for a particular company in which you have some sort of interest, if you give them money to just get a favorable recommendation from them, then you are in violation of this particular standard. Analysts may face pressure or receive inducements to give a security a specific rating. If you are working in a credit rating agency, for example, then you might be pressurized by your employer or the client itself to give good recommendation for that particular security or rating or an issue or whatever the case may be. So if you are giving a favorable recommendation because of that, then you are in violation of this standard. You should give recommendation which is fair, which is correct, which is based on reasonable due diligence, and to select certain outside managers or vendors or produce favorable or unfavorable research and conclusions. So it can be outside manager as well, vendors as well. Unfavorable research and conclusion. Okay, members who allow their investment recommendations or analysis to be influenced by such pressure or inducements will have violated the requirement to use reasonable care and to maintain independence and objectivity in their professional activities. So, if you are pressurized or you get induced by whatever offer they are giving, then you are in violation. If you change your recommendation by accepting the gifts, you are in the violation of this standard. Allocating shares in oversubscribed IPOs to personal accounts is a violation. So if there is an IPO and you have a lot of clients who wants to buy that particular IPO, then you should subscribe that particular IPO for all of your clients before taking it. And if it is before taking for yourself, and if it is oversubscribed, then you should never ever take you should never ever allocate those shares in your account. Normal business entertainment is permitted. So as I said, token gifts, normal business entertainment which is not that expensive. And how to differentiate between a lavish gift and a normal gift. So you will be able to read, and you will be able to understand whether the gift is reasonable or unreasonable. Lavish hotels or lavish something like that, if you believe that it has a substantial value, that means that the offer is substantial and it can further violate this standard if you accept that. So members who accept, solicit or offer things of value that could be expected to influence the members or own or others' independence or objectivity are violating the standards. Gifts for clients are considered less likely to compromise independence and objectivity than gifts from other parties. So let's say if you have a client and that client wants to give you gift because you have given him very good performance, and you have surpassed the benchmark, and client was very happy with your performance and he decides to give you compensation because of that. So that particular compensation is completely okay after giving performance. Like if you have already given the performance, and then if client decide to give you gift, that's completely okay. Client gift must be disclosed to the member's employer prior to acceptance. This is important. Prior to acceptance if possible, but after acceptance if not. So due to some reason you are not able to contact your client, and you accept the gift, and later on you tell him that okay, I have this particular gift from client, and he just gave this gift to me. If you say that after accepting it, that's also completely okay, as long as you are telling him and as long as a gift doesn't impede your independence and objectivity. If by any means, if your independence and objectivity is compromised, then you are violating this standard, even if you inform your employer. So you should make sure that you are accepting gift, but accepting gift after before delivering the performance is clear violation, but after delivering the performance is not a violation. Members may prepare reports paid for by the subject firm if compensation is a flat rate not tied to the conclusion of the reports, and if the fact that the research is issuer paid is disclosed. So if it is a flat rate compensation that your employer is giving, or maybe the issuer is paying you, if it is a flat rate, then it's completely okay. But let's say if your bonus is attached with the kind of recommendation you are giving, meaning if you are giving a positive recommendation, you will get more money, and if you give a negative recommendation, you will get less money. So if that is the case, then uh, you are violating this particular standard of independence and objectivity. So if the compensation is flat rate, that's completely okay, that's completely fine. But if it is not flat, and if it is tied to any sort of conclusion of the report, then you are in the violation. And if it is issuer paid, then it must be disclosed so that your client know that this particular issuer has actually paid you, and he can take decision accordingly. So he know that okay, this ABC firm has paid certain amount to you, and you are giving recommendation uh, based on that. So it's important to disclose it. The main purpose of this standard is to protect professional independence and integrity of judgment. Members and candidates must always ensure that client interest come first before personal and employer's interest. So this is a standard thing. So the first is client and the integrity of capital markets. Second is employer, and third is your own self. So client comes first, then your employer, and um, then you yourself. So any gift, incentive, or pressure that could influence decision making is considered a potential conflict of interest. Let's see investment banking relationship. So analysts may face pressure in situations where conflicts are common, such as pressure from corporate issuers to provide overly positive research, especially during IPO or security offering. So you will be tasked to uh, provide a valuation for an IPO or a security offering. And if you issue a positive research, but you believe that actually this firm will not do good because it doesn't have any good future projections, then you are violating this standard. Because if you are giving positive research by putting false information, you are violating the standard. Pressure from internal investment team to adjust ratings to benefit firm owned portfolios. So you might be pressurized from internal investment teams as well. It can be your employer as well who can pressurize you, your senior, if his compensation is attached to how positively you are showing the research. Then you might be benefited. Then you might be pressurized to give positive result. So accepting or acting on such a pressure is a violation of the standard, as it compromises independence and objectivity. Issuer paid research. When an analyst is compensated directly by the company being analyzed, there is a high risk of bias and loss of objectivity. To comply with the standard, compensation must be pre-agreed, fixed, and independent of research outcome. So these three lines are very important. Three words are very important: pre-agreed, fixed, and independent of the research outcome. Payment must not depend on the rating, recommendation, or findings. Analysts must ensure full transparency of the relationship, meaning that they have to disclose that issuer paid research report is something that I am giving to their clients. Any performance based or outcome based compensation structure is not permitted. Gifts and entertainment. As I discussed earlier, token gifts like small customary items like pens, calendars, modest meal. If you see the word modest, then also it's completely okay. It's inside the token gifts. So you have to look for these word like luxury, expensive, excessive. all of these words can reasonably influence your decision making. So non-token gifts are not allowed, but token gifts are completely okay. Gifts from clients. Gifts given as appreciation for past performance are less likely to create a conflict, but they must be still. So, as I said before, if you have already given a good performance, and because of that, if your clients give you gift or something, that's completely okay. But you still have to disclose it to the employer so that your employer can monitor how you are behaving. So, reviewed under firm's policy. Accepting compensation that is dependent on the conclusion, recommendation, or market impact of the report, and failure to disclose that research is issuer paid are violation of this standard. So if you are not disclosing that this particular research that I have done is issuer paid, then you are violating. So you should disclose it to your client that particular information that you are giving is issuer paid. Maintaining firewalls. So members, candidates, and firms must maintain independence and objectivity by implementing strong firewall policies between research and investment banking functions. So in one investment bank, there are a lot of functions that investment bank performs. So there is a research department, there is an M&A department, there is an administrative department, there is an HR department. There is a department where portfolio research work is going on, or allocation of assets is going on. So whatever the case may be, so each and every department is independent, meaning that there should be a firewall created so that information from one department is not passed on any other department. If it is passed, then you will be violating this particular standard, because if you are giving information to someone else regarding a particular company, then that particular person or that particular department can act on that information, which will further violate the standard. These barriers should include separate reporting structures where investment banking personnel have no authority over research reports or recommendations, and communication between the two groups may be restricted or closely controlled. Compensation policies should also support objectivity by rewarding research quality and accuracy rather than linking analyst pay to investment banking deals. Firms should regularly review these safeguards and ensure that conflict of interest disclosures are clear, specific, and prominently presented to maintain transparency and protect analyst independence. Now, talking about travel expenses. Accepting paid travel can provide benefit beyond cost savings, such as access to companies' executives and deeper insight into investment opportunities. So it's always a benefit for a particular member or candidate that if their travel is paid, then it will help them to save a lot of money. However, it also creates a risk that members and candidates may appear to lose independence and objectivity, especially when travel is fully sponsored through corporate jets or conferences that cover airfare and lodging. To avoid any actual or perceived conflict of interest, the best practice is to use commercial transportation paid by member, candidate, or their firm. Only when commercial options are not reasonably available may modest necessary travel arrangements from an external party be accepted. So it's written that you should always pay for your own travel. If you have to, let's say, go to a remote place where there are no where there is no travel available, or where the transit system is very bad, then in that case you can ask for some sort of a compensation so that you can get the most modest, reasonably available means of transport to that particular remote area. Only in that case you can ask for travel arrangements from your client, or if your employer is paying, then also that's completely okay. But apart from that, if you're going anywhere else, you have to pay or your employer have to pay, but your client should not pay for that. If your client is paying for that, then it is possible that it might violate the standard, because uh, it may appear that you might lose your independence and objectivity. So it is possible that you give recommendation in their favor because they are giving you lavish travel and all the luxury amenities. A recommendation for members. So what members should do? So restrict special cost arrangements. Members or their firm should pay for their own travel to company events or tours when practicable, and limit use of corporate aircrafts to trip for which commercial travel is not available. So they should restrict any special cost arrangements, and they should limit any commercial travel where there is no alternative available. Create a restricted list. If the firm is unwilling to permit dissemination of adverse opinion about a corporate client, so if a firm is not permitting that adverse opinion against any client, member or candidate should encourage the firm to remove the controversial company from the research universe and put it on a restricted list so that the firm disseminates only factual information about the company. This is important as well. So firm should create a restricted list if there is a company with whom the firm has created good relationship, and if that particular company ask for recommendation and you believe that the opinion is adverse and which can further impede your relationship or anything, you can create a restricted list for certain companies by which your relationship can be hurt. So in that case, you should not accept projects from those companies, and you should put those companies into the restricted lists. And if you are disseminating any information about that firm, that information should only be factual, and it should be about the company. A written independence policy. So members, candidates, and their firm should establish a formal written policy on the independence and objectivity of research, and implement reporting structures and review procedures to ensure that research analysts do not report to and are not supervised or controlled by any department of the firm that could compromise the independence of the analysts. Appointed officers. Firm should appoint a senior officer with oversight responsibility for compliance with the firm's code of ethics and all regulating concerning its business. Recommendations for firm. So what are the recommendations from firm? Employee restriction. Restrict employee participation in IPOs and private placements. Require pre-approval for participation. If they want to participate in any IPO or any private placement, then they should get approval for their participation from the firm. Limit the gifts. Limit gifts other than from client to token items only. Let's see the questions. Arjun Mehta is an equity analyst at Orient Securities. A company, Novatech Limited, is about to launch an IPO. The investment banking team at Orient is handling the deal and pressures Arjun to publish a strong buy. Clearly, they are giving pressure to report to support investor demand. Now, Arjun should not be influenced by the pressure which their firm is giving. Arjun believes the stock is overvalued. If Arjun believes that the stock is overvalued, then he should say that, okay, fine, this stock is overvalued. Arjun must maintain independence and objectivity. He must base his recommendations solely on fundamentals, not investment banking pressure. He should issue his true view, even if it is negative. If pressure continues, he should escalate to compliance or senior management and ensure separation between research and banking function. Sophie Lynn is hired by a marketing firm to write a research report on Brightwave Inc. The firm will pay her a fixed plus a bonus if investor buy Brightwave stock after reading her report. It's a clear violation. No, Sophia would violate standard 1B. Compensation linked to investor response creates biases and threatens objectivity. She should only accept a fixed pre-agreed fee that is not tied to report conclusion or market reactions. Maria Khan manages a high net worth client portfolio. After a strong performance, her client gives her expensive concert tickets and a week long stay at a luxury apartment. Maria informs her supervisor. After a strong performance, so performance is already delivered, her client gives her expensive concert tickets and a week long stay in luxury apartment. Now, this is not modest. This is expensive and luxury, but you see, after giving strong performance, and she informs her supervisor as well. If she has not informed the supervisor, it's a violation. But she informed her supervisor. After strong performance, she is accepting gift, or her client is giving her gift. So it's completely okay. Yes, Maria is in compliance with standard 1B because she disclosed the gift to her employer. Client gifts are less likely to impair objectivity, but disclosure is required so the firm can monitor potential bias or potential treatment. Why disclosure is important? Because firm can monitor potential bias or preferential treatment. Karan Desai is an equity research analyst at Metro Securities. He is invited by Alpha Mining Limited to join a site visit with other analysts. Alpha Mining arranges chartered flights between remote mine locations and covers hotel accommodation for the group. Karan's firm does not reimburse these costs. During the trip, Karan also spent significant time with Alpha Mining CEO, who provides additional insights into future expansion plan. Karan believes that trip helped him better understand the company and later issues possible a positive research report. Now, if he believes that he got a lot of information, and then if he gives research report, and if he considers it as a positive research report, that's completely okay. Karan has not violated one. The paid travel arrangement should be chartered, such as chartered flight and modest accommodation for a legitimate business purpose. Site visit may be acceptable if they are reasonable, not lavish, and necessary for information gathering. In this case, the arrangement appears operational and industry typical.